I am live here for a Friday lunch session where we are going to answer any of your real estate investing questions live here from Santa Barbara, California. They can be local questions, it could be national questions, it can be the city you're located in. So just post any questions that you may have, and we're going to answer them right now. I've got a few that have already come in as we prep for this. Hey, Melanie, welcome. All right. I see the first question that someone sent in pre going live here was they're asking 4, 5, or 20 units. So far, they've only done single family investing. So they're asking, I guess, what's the next step? So 4, 5, or 20 units. Let's see. If you've done single family, then it's not that big of a jump. There's not that much of a difference. You basically will have more doors under the same roof, right? Like a single family, just take a larger single family with more doors under the same roof. But once you hit the threshold of 5 units, you're going to go into commercial financing. So it's a little bit different. If you're 4 units and under, you'll be in residential financing, and it's easier to get the loan, especially if you're going to do what's called house hacking, like you're going to live in one of the units, or you're going to live in like an owner's unit or the main house and rent out the others. Then you can get residential financing, which typically means better terms, maybe a lower down payment. The interest rate might be slightly lower. But if you go 5 units and above, it's commercial financing. So again, welcome. If you've just joined us, I'm answering real estate investing questions live. I'm talking to real estate agents that are investing. I'm talking to real estate investors that are investing. Post your questions and I will answer them here as we go. All right, so that's the first difference on that question between jumping from single family to multi-units, is that once you go above 5, then you're going to go into a different lending category, and there may be certain lenders that will only lend it on residential on 4 units and below, and so you may have to find a different lender for 5 and above. Other than that, it's a great jump to do. You can sell a house if you have a rental house that maybe you've owned for a long time. You can sell that and do a 1031 exchange, which is a way to sell it tax deferred, not pay the taxes on it, and exchange up into a bigger building, into multi-units. So you're essentially playing Monopoly. And if you've gained equity on that single family house, as long as it was an investment property and you didn't live in it. Although there's a nuance to that, where let's say you lived in part of it and rented out part of it, then you could do part as your primary residence and part as investment property. So again, welcome everyone who's joining us on the live feed. Just if you have questions, pop them in. I will answer them live. And I'm going to move on to the next question right now. Okay, so next question is, if you had only $10,000 to invest, Bill, thanks for this question. How would you invest it? So if you only had $10,000 to invest in real estate, how would I guess he's asking if I was him, how would I invest it? And that's a great question. So with $10,000, and I have a YouTube episode on this, but I would first of all invest in yourself, right? So get educated, get some real estate education around real estate investing. And it's usually stuff it's going to be very difficult to find in a university type environment. There's some great books you can get. There's a great online, basically network called Bigger Pockets. The only downside to something like Bigger Pockets is there's thousands and thousands of people on there, and everyone's got an opinion, and some of the opinions are wrong. But it's also a great resource, and it's free. And there's a lot of good books to check out, and then there's some good YouTube people you could follow. So get educated on real estate investing, and then start small. Start with something that's doable for you, and educate also yourself on how to improve what you bring to the marketplace to increase your income. So it's about becoming attractive to a bank, because you're going to want to leverage. If you've got 10,000 to work with, you're going to want to save for the down payment, and then leverage, right, as much as you can. Well, the way to leverage is with a bank. And so you want to find out, what is it that banks are looking for? You want to get your credit score up and get your income up. The way you get your income up is you improve the skills that you bring to the marketplace. So that might be getting a license or getting a tradesman skill. It could be working your way up as a plumber from a journeyman to a master plumber, or getting a license as a real estate agent. Reach out to me if you're interested in that. It could be getting your license as a dentist or something in the medical field, or becoming an appraiser, anything where you're improving the skills that you bring to the marketplace, which will increase your income. You'll increase your credit score, and then you will become more and more attractive to a bank and be able to leverage heavily. Welcome, Joe. Welcome, Jesse. Welcome, Josh. I'm live streaming to a couple places here, so throw in any questions that you have, and I look forward to connecting. Thanks for the popcorn, the waves, and all the likes. All right, next question. Can I get a loan from you? Okay, that's a good one. All right, I'm not giving out loans today. I am giving out some free education here on real estate investing. So if you have a question on real estate investing, pop that question in, and I'll answer it live here, whether you're a real estate agent looking to get into real estate investing, or if you're a real estate investor. Next question from Rebecca. How to scale after my first duplex? I like the area I invested in. It's out of area from where I live, but I'm hesitant to get another loan. Okay, so how to scale from a duplex is what Rebecca's asking. I'm not sure, Rebecca, why you're hesitant to get another loan, but that I don't know the nuances there. But I do know that there's some lenders, especially if they're government backed, they'll limit the amount of loans that you can have. But I don't think you need to worry about that, because there's other lenders that really don't care. And especially as you grow more and more, you're going to be transferring things out of your personal name and into an LLC, and it's going to be corporate commercial lending anyways. So on the lending, I wouldn't be hesitant on your second real estate purchase, but maybe there's a reason you are, and I'm not sure. You can post that. But how to scale after your first duplex? So maybe you see if it's working with your first duplex, maybe you're going to get another duplex. Maybe you're going to get a 4-unit, or maybe you'll make the jump into multifamily, into commercial, into 5-unit or above. It'll depend on your financial situation, what you've set aside for a down payment. It also depends if you're going to sell that 2-unit and do a 1031 exchange up into a larger property, and defer any gain on the taxes by doing that. That's where I would move, is to either add to your portfolio or you can trade up. For me, I have a YouTube episode. It's a master class under basically the story of how I traded up for 20 years from a condo to a 74-unit. And so you can trade up. And when I say trade up, I mean 1031 exchanges. So that's where you are selling one property and buying another investment property. And it can be totally different property. As long as it's investment property for investment property, it doesn't matter if you're going from a single family to a multi-unit, or to a piece of land or an office building, as long as it's investment property for investment property. All right, we got a question coming in live right now from Joe. Is it safer bet to invest in commercial projects versus residential? Great question, Joe. So again, that will depend on a lot of things. First of all, in commercial, like when you say invest in commercial, that can mean all the different categories, right? So commercial can mean office, it can mean retail, it can mean industrial, it can mean all kinds of scenarios in there. So when you say commercial, I'm not sure which property type you mean, but I'll dissect a couple of them right now real quick. Retail can be a little bit funky right now, right? It's been a little funky for a year, not just because of COVID, but even before that, with online retail really took a shot at a lot of our retailers went bankrupt before COVID even came around. And then COVID made it even more weird for retail. So retail's a little bit unsure in my book, but it can work, and it can work great. There's triple net options where you're buying a property that can be, usually it's more retail oriented. Let's say like a Bank of America is in the property and it's a triple net. The Bank of America takes care of everything, all maintenance, all property tax. They take care of the whole property. You get a check every month. And so those can be really safe bets depending on who the tenant is and who's backing that lease. Other things in commercial work great as well. It could be a mixed use opportunity. There's one we're looking at right now where it's a restaurant going in, a new restaurant, and we've checked out this guy's already running successful restaurants. We went and checked one out ourselves, and it was great. And then the other spaces have smaller retail space, and there's some office. Sometimes you'll have mixed use residential mixed in there, and those can be great depending on the location, the leases that back it, and all those things. Commercial versus residential. Residential is nice because people need a place to live. We owned residential all through the ups and downs of the past 20 years. So during the Great Recession, we were all in on income producing property, on residential property. And that worked great during the recession because the rents did not go down and people did not move out. Now, we were in middle income property, so we weren't in the high luxurious stuff, which I think can get hit harder. And the very low end can also get hit hard during a recession. Think about it. If you're in high end luxury and people are thinking about ways that they can cut back, the ways that they can save money, they might pull back. And on the luxury side of things, and luxury housing might have more vacancy. On the low end, you're in affordable housing or you're in neighborhoods where it's just really low income neighborhoods. Those people during the recession can really be going through a lot with work and trying to make ends meet with their bills. So those two extremes can get hit pretty hard in a recession. So with residential, it's nice to be somewhere in the middle range for residential. All right, great question. More questions coming in. Welcome everyone who's joining us. I'm asking, you're asking me real estate investing questions, whether you're a real estate agent wanting to get into real estate investing or grow your portfolio, or you're a real estate investor, or you're wanting to get into real estate investing, go ahead and shoot me a question. All right, next question that's come in here. This is from Mike. Just getting started in real estate investing. What type of property is best? Okay, so we addressed that a little bit on what type of property is best in terms of residential versus commercial, but the question really is what type of property is best for you. So that may depend on your local market, especially if you're just getting started. So if you're just getting started, I would recommend with investing with what you know, right? What do you know about your neighborhood? And if you don't know anything, we'll start getting to know, go out and looking at properties. It's either that, or you're going to invest with someone else who's more experienced. You're going to invest with someone who's got a group that's investing. We do that. We've partnered with investors in the past, and with their 401ks or with their investment money, and we partnered with them on opportunities, and then they get paid a return out of that opportunity, and then they get to learn and not have all the responsibility of the property. So you may want to go in on something, but just do your due diligence. Make sure you check out the track record of anyone you're going to go in on. That could be a good way to start. But if you want to get started and you're looking to build something yourself, then get to know your local market. Go out and start looking at properties. Get involved within real estate investment clubs that are there, and educate yourself. And then, as I described earlier, improve what's attractive to you, to an investor, about you to an investor. So, and to a bank, to a lender. So your credit score, your income, make it so that the banks love you, and then they will leverage. They'll become like your partner at a very, very low interest rate, and they will basically loan 80% or more if you're occupying the property. So, sorry, I'm looking over here a little bit because we got Instagram over here, and I got Facebook over here live, and YouTube as well. So welcome everyone. If you're new, I see a few people joining. I am answering your real estate investing questions, and I am helping out if you're a real estate agent that's looking to get into real estate investing, or you're a real estate investor or looking to get into real estate investing, and you're not an agent, or you're thinking about getting your license. Either way, reach out to me. All right. Other questions that's come in. Let's see here. Okay. Would you use a HELOC HELOC, home equity line of credit, on a current home as a down payment? Okay, yes, I would. However, there's a lot of caveats there. There's things to be careful with. With the heat lock, you want to be careful because, first of all, they typically have interest rates that are adjustable, right? So let's say you're going to pull money out of your property as an equity line to invest, and I've done that before. I've pulled equity out of a property to use as a down payment on another property, and that's fine, but you want to read the fine print. What are the details in that home equity line of credit? How much can that interest rate go up? Is there a cap to how much it can go up? And how much can it adjust, right? Because that's going to be a monthly cost that you have to factor into that new investment. So that's something to think about. All right. So any other real estate questions, please pop them into the comments. I'm answering anything that comes in live regarding real estate investing. And let's see, anything else? The difference between single family and multifamily. I think I already talked about that a bit. The difference between residential and commercial. Come on, here we go. Here come some more questions. All right, Josh, if you live in a high priced housing area, yeah, I know where you live, Josh. Is it better to invest out of state? Man, great question, Josh. And I have been investing out of state for, let's see, since 2006. So what is that? Over 15 years. And I honestly have caution flags about it. It's something you really, really got to think through and think about, because the hardest thing is real estate, especially if you're talking about rental property that someone's going to live in. It's really detail oriented. And I've always struggled finding really good property managers that are able to do it all and keep track of it all. Because really, if you're a property manager and you're managing like single family rentals or even multifamily, they have to manage a lot of properties to really cover their overhead and make a living. And so when they're managing a lot of properties, they're running around like a chicken with its head cut off. I mean, it's a lot of work to manage. And so that is something to think about with do you have a really good property manager? Is there a certain area you're thinking about that you could invest? Because yeah, the returns can be better, the cash flow can be better, but what's the cost? And what could go wrong if you're not there? And so just certain things to think about. But with that said, it could work great if you've got the right scenario where you've got the right area. Maybe you know people in that area, or maybe it's an area you grew up in, or maybe it's an area you go back to and you travel to and you're getting to know that area, and there's an investment there that you can get in on, then it might be a great opportunity. But again, as you're educating yourself and you're learning about that, there's a great book called Hold that Gary Keller put together. And that book would be really good to read. Hold, H-O, like buy and hold real estate. And so those are some things to think about with out of area real estate investing. Okay, awesome. All right, I think we're good. I've just flew through, I don't know how many, maybe we hit 10 questions there. Thanks for tuning in. I'm going to do this again. I'll announce it on social media. We'll do it again next week, answering your real estate investing questions live. We will see you next week. Have a great weekend, everyone.